Hi, my name is Brenton Harrison, and we're here today to answer the question of whether or not you can refinance your student loans more than one time. Let's get started. If you're watching this video, you may be a person who used to have federal student loans and found yourself in a situation where it might have been advantageous to you, maybe because you got a better interest rate or more favorable repayment terms, to take that loan from the federal government and refinance it with a private lender. So you did that one time a few years ago, and you keep seeing these notifications and these stories, these emails about rates on private loans dropping further and further down. And you might wonder to yourself, am I in a position or is it beneficial to me to possibly refinance my loans again? Is that something people do? Does it hurt me more than it helps me to do so? And how do I figure out this information? Well, that's why we're making this video. And the short answer to all of those questions is it can definitely benefit you to refinance your student loans more than one time. And not only that, I often recommend to my clients that they look into the possibility of refinancing their private student loans as often as once every single year. Now, that doesn't mean they refinance it every single year, but it does mean that it can financially benefit you to at least take a look at what the interest rates are as compared to your current student loan. There are a couple of reasons why investigating the interest rates on current student loans when it comes to private student loans doesn't harm you and gives you the ability to see what's available without worrying about having any negative repercussions when it comes to your student loan. Now, I will give you a quick tool or a tip or trick of the trade when it comes to FICO scores and credit inquiries, and it has to do with a hard inquiry, which we'll get into in a second, of your credit when you're shopping in one particular area. Here's what that means. You might be looking for cable, going back to our example, and maybe you go to cable company A and you have them do a hard inquiry and they check your credit. Now, because that's 10% of your score, it may make your score go down temporarily. And maybe you see that the rates at company A aren't as competitive as you thought, and you want to go to company B and company C and company D to see what they offer in terms of your cable. Now, some people may be afraid to do that because they're worried that that might be 3 to 4 additional inquiries when it comes to their credit score. But fortunately, within a 2 week period of the original inquiry, if you go shopping around for rates in the same category, it will only show up as one credit inquiry on your report. They'll see that you're shopping around in that category and they won't ding you multiple times. Now, that's different if on January 1st you get cable company A to check your credit, and then you go look for a car loan on January 2nd and get a credit inquiry there. That's two separate inquiries. But when you're shopping within the same field, having it within that 2 week period prevents you from having multiple credit inquiries damage your report. Now, that's in the instance where it is what's called a hard inquiry. A hard inquiry or a hard pull of your credit is when a company checks your credit and it actually impacts your score. Thankfully, when it comes to private student loans, they do not do hard inquiries when they pull your credit. They do what's called soft inquiries of your credit. And a soft credit inquiry allows them to get certain information about your score without actually doing a hard pull and damaging what you see in front of you. So that's one reason why it benefits you to investigate the rates if you see they've dropped on private student loans, because you can get a tentative rate from a carrier or a lender without actually doing any damage at all to your credit. So that means you have the freedom to check with 4 or 5 or even 6 or 7 companies over the course of more than 2 weeks. It could be a month, it could be a couple months as you shop around without worrying about the negative impact on your score. Now, let's say that you've gone through the process of looking through different carriers when it comes to private student loans, and you see a rate that's better than what you have, but it's only a minimal improvement. Now, if this weren't a private student loan and it were, for example, say a home loan, you might be hesitant to refinance your student loans if it's only a minimal improvement. And that's because when you do things like home loans, you have something that's added on to the cost of the loan called origination fees, or in the case of a home loan, you might be familiar with the term closing costs. Origination fees are simply fees that are required to originate the loan process, or in the case of a home, to close out the loan process, and it can add a lot of cost into the refinance process. For example, if you have a home loan and your home loan is $200,000 and you pay 2 points or 2% in closing costs, then it will cost you $4,000 just to close that loan. And you may look and say, what's the point of me going through another refinance to save 0.10% on the loan if it costs me $4,000 to go through that process. Now, you might be tempted to think that it's similar with private student loans, but fortunately, when you go from one private student loan carrier to another private student loan carrier, there are no origination fees. So if you have a $100,000 loan, there are no costs to take it from $100,000 with company A and move it over to a better rate at company B. There's no cost involved, and you get the benefit of the lower interest rate, which means that you can take your company from A to B to C to D to E to F as many times as you want to without worrying about costing yourself in the process. Those are two reasons, one based on how they check your credit when it comes to figuring out your interest rate, and another in terms of the cost or lack of cost to refinance, that it might benefit you to refinance your loans more than one time. But now let's get into 5 specific reasons why you might go through this process in a way that benefits your finances. The first reason that you might refinance your loans a second or third or fourth or fifth time is your credit is improved. Now, I know what you might be thinking. You might be thinking, my finances feel like they're in pretty much the same position they were. I haven't changed my behavior since the last time that I refinanced. But if you go back to the components of the FICO score, you'll see that two of those components can benefit you just by the course of time. For example, if you have those private student loans and you've paid on them and you've paid on time over a course of time, a course of years, then 35% of your score being your payment history can benefit you and improve your credit just by you making timely payments. You'll also remember that 15% of your score is the age of your accounts. And the age of your accounts is simply a reflection of how old your average account is. How old is your credit? So the longer you've had an account open, even if you feel that you might not have managed it well, that combined with positive payment history is half of your FICO credit score. So if you can keep those two components in check, you can find that over the course of time, your credit has improved, and credit is one of the components that factors into the interest rate you receive with a private lender. The second reason is you might have an improved debt to income ratio. Debt to income ratio is something we've covered in the past, but it is simply a reflection of how much you have in monthly bills in relation to your monthly income. It's a ratio that reflects how leveraged you are financially. For example, if you have $5,000 of monthly income and $4,000 of monthly bills, you have an 80% debt to income ratio. And that's really high. The lower your debt to income ratio is, the better you position yourself to get a favorable interest rate for things like student loans. And we see all the time that when people first refinance their private student loans, they may have a debt to income ratio that's not that favorable. And again, this is an example of you in a position where you might not feel like you're doing better financially, but just the natural progression of your income can help improve your debt to income ratio, even if the bill or the payment itself hasn't decreased. Going back to our example, if we have someone who has $5,000 of monthly bill or $5,000 of monthly income, and $4,000 of monthly bills, they have an 80% debt to income ratio. And that's way too high. Many lenders want you to be in the low 40% range before they'll give you additional credit. But let's say over the course of the years, that person's payments haven't changed, their bills haven't changed, but their income has increased. So now they make $10,000 a month. So their $10,000 a month and $4,000 of monthly bills now gives them a 40% debt to income ratio, which is well within the range of what lenders are looking for and might make them eligible for an improved interest rate on their current student loan. Yet another example of improving salary, not improved behavior, but still being in a position where you can get a more advantageous rate on your loan. The third reason you might refinance an additional time is you might have an improved cosigner. So if you're familiar with the private loan process, it is very, very common for a private student loan lender to require that you have a cosigner when you get that loan. And a cosigner is someone who is signing up for equal responsibility to repay that debt. Now, as a different conversation, I would say that unless there's just no way around it, I would never encourage you to co-sign on someone's debt because there are very extreme examples of when someone else abandons their duty either because they have to or they've chosen to, that cosigner is still responsible for paying the debt. And if they don't, it will reflect negatively on their credit report, even though they weren't the ones who needed the money. So as an aside, I would discourage you from signing up as a cosigner if you can avoid it. But if you're in a situation where you're the person taking the loan and you have to have a cosigner, when you first applied, you might have had a cosigner whose finances were only marginally better than yours. And oftentimes, the rate that you receive and the payment period that you receive is based on your cosigner's financial strength. Well, maybe now, years from now, you have a cosigner or the same cosigner whose finances have improved immensely. And you can use the power and the strength of their financial profile to potentially improve your credit, your interest rate on your student loans when you refinance with a new lender. So you can find someone you trust, you can find someone who has done well financially, and if they agree to take on that responsibility, or even the old person who's just had improved finances, it's definitely worth seeing if you can refinance and have their strength reflected on your interest rate. The fourth reason is removing a cosigner or removing a parent from the obligation of repaying your loan. So we talked about being in a position where you have to have a cosigner, as is common with private student loan lenders. But you could get yourself in a position where your finances are strong enough that you no longer need a cosigner in the eyes of your lender. Now, you could have some cosigners who have what's called a cosigner release. And that's an option that you can take advantage of where you can apply at a certain point in time and ask to be evaluated on the merits of your finances. And if they approve, they will drop your cosigner from your loan without having to refinance. But if you're in a position where you don't have a lender who has a cosigner release, you could refinance that loan with a new lender who does believe that you're able to carry that debt on your own and you can release your cosigner from the obligation of that debt, which is something that many people want to do as quickly as they can. Conversely, if you have a parent where you are in a position as a graduate student, or maybe you are that parent for your child, and your child or you as the student couldn't qualify for certain student loans, Parent Plus loans are federal loans that parents take out to provide their children with the funds to go to school. And I've seen many people whose parents have taken out six figures worth of loans to finance their education or $50,000 of loans to finance their education. And the thing that they want to do most in the world is to make sure that that parent isn't burdened by that payment. You have students who will make that payment for their parents, but in the end, it's still reflected on the parent's credit report and it's still their financial responsibility. Now, when you have a federal loan that's a Parent Plus loan, there is no way to refinance within the federal government to have a parent's loan now be the responsibility of the student or the child. But what you do find now is in recent years, you have private lenders who will take a Parent Plus loan in the name of a parent and allow them to refinance that loan with the private lender in the name of the student. So if you're in that situation where your finances are now strong enough to take on a debt that your parents initially took on for you might refinance with a lender. Even if your parents went from federal loan in their name to a private loan in their name, you can now take that private loan and potentially put it in your name and release them from that burden. The fifth and final reason that you might refinance beyond just a simple drop in interest rates is switching from a variable rate loan to a fixed rate loan. So there are two major ways that you can repay private student loans. One is a fixed rate loan, and that's pretty simple. Your rate is fixed. You have a set amount of time, be it 10 or 15 or 20 years, and you have a fixed rate, and every single year that you're paying back that loan, you're paying it back at that same fixed interest rate. But there's a second way that you can repay private student loans, and that's a variable interest rate. A variable interest rate is when a lender gives you a range of interest rates. For example, let's say 3.5% to 5%. And they look every single month or every single day or every single quarter, depending on the lender, at some type of measurement to determine what interest rate you're going to pay within that range. For example, there's an exchange called the London Interbank Offertory Rate. And that's just an exchange or an interest rate that basically one bank uses to determine what they're going to lend to another. So if a bank borrows from another bank, the LIBOR is the interest rate that they are charging that new bank that they're lending the money. So many private student loan lenders will use that LIBOR as the basis for what they set their variable interest rate. So they might say, we are going to charge the LIBOR plus 0.25%. So if you have a private student loan and the LIBOR is 4%, then you're going to pay 4.25% on your loan. Now, the problem with the LIBOR is it changes frequently, which means that the interest rate that you pay on your student loan could change frequently. So going back to our example, if they gave you a range of 3.5% to 5%, they're saying at any point in time, you could be paying anywhere between 3.5% and 5%, but it could change as frequently as monthly or daily, depending on your lender. Now, why would somebody do this? Well, they do this because typically the lower range of a variable rate loan is more competitive than what you'll find with a fixed rate loan. You might have the lower range of a variable rate loan be at 3.5%, while a fixed rate may be at 4%. So people will use a variable rate loan hoping to take advantage of the low interest rate as long as they can, as compared to what they would pay with a fixed rate. However, the risk with a variable rate loan is that that interest rate might creep up and it might creep beyond the point of what's available with the fixed rate loan. So in our example, if you have a variable rate loan that starts as low as 3.5%, and you have it that where the interest rate keeps increasing and increasing and increasing, and now you're consistently paying 4.25, 4.5. Well, you might look at that loan and say, you know what, I'm paying 4.25%, but there's a fixed rate loan at 4%, and I can lock in that rate with a new lender and not worry about that increase over the course of time. That's a reason that you can take for your student loans to put yourself in a more predictable position in terms of what your payment will be and how much it will cost you to pay off that loan over the course of the years. That's it. I hope this video was beneficial to you. I welcome you to reach out to us if there's topics you want to hear about in the future that you'd like us to cover, and we look forward to bringing you more value soon. Have a good one.